For decades, Renaissance Technologies' Medallion Fund has represented the asymptote of quantitative finance. Their approach treats the global market as a high-density signal processing problem. To solve it, standard quants deploy arrays of hidden Markov models and deep learning architectures across exabytes of historical data, attempting to isolate microscopic, non-random signals buried within market noise. But as high-frequency trading fragments across dark pools and diverse global exchanges, the dimensionality of that data scales exponentially. This is a standard covariance matrix. When models analyze time series vectors like price, volume, and macro variables to capture cross-asset correlation, a market of n variables creates a state space growing to 2n. The resulting grid multiplies outward until hitting a hard computational choke point. To survive this data load, traditional machine learning models must truncate dimensions, aggregate data, or assume market stationarity. Pure time series analysis contains a mathematical limit. It cannot scale with modern market complexity without sacrificing the data resolution required to identify those signals. Breaking this limit requires shifting data representation from distinct time series vectors to continuous topological geometry. This shift is achieved through a dual architecture: Tensor-Network Quantum Gravity, or TNQG, for signal detection, and the Predictive Tensor Control Plane, PTCP, for execution. This framework moves beyond the search for localized statistical deviations from historical means. Instead, the framework identifies market alpha as topological defects, physical warps or severe structural irregularities embedded directly within a continuous geometric fabric. By mapping the global financial order book and physical market infrastructure into a unified geometric space, the model bypasses the computational bottlenecks of discrete vector analysis. A standard quantitative covariance matrix calculates discrete market relationships point by point. The TNQG model replaces this calculation with principles derived from quantum many-body physics. Here, TNQG compresses the entire global financial order book into a continuous tensor network state, labeled psi. This state generates equation 1, a global density matrix representing the entire posture of the FSI order book. Because the market is represented as a single macroscopic geometry, the system evaluates the entire space simultaneously, rather than calculating individual pairwise correlations. This allows the system to evaluate entanglement entropy, a measure of the multi-asset correlations linking different segments of the global market. This geometry preserves deep correlations that are invisible to the localized calculations of standard Markov models. Through tensor networks, the complexity of infinite market variables becomes the structural foundation of the model rather than a computational burden. Consider a momentary pricing mismatch between a derivative in Chicago and its underlying asset in London. Standard models read this as a price divergence on a localized graph. In TNQG, this mismatch is a structural warp in the probability geometry. Here, we see the expected theoretical manifold of market behavior. The live observation data drops onto this smooth grid to reveal the intersection. Equation 2 uses quantum relative entropy to quantify the exact mismatch between these two layers. As the manifolds intersect, R of t generates a localized spike, a topological defect in the geometric field. This spike in the relative entropy gradient indicates an arbitrage opportunity that is mathematically distinct from Gaussian noise. The defect represents a structural deviation rather than a statistical fluctuation. By identifying alpha through these defects, the system differentiates structural inefficiencies from the random noise that complicates standard statistical models. Identifying alpha is only effective if execution latency is minimized. Even a perfect signal loses value if slippage occurs during routing. Classical algorithmic bots rely on shortest path switch routing, following protocols like BGP. When many algorithms utilize the same shortest path, it results in bursts of congestion at the exchange colocation center. The Predictive Tensor Control Plane, or PTCP, acts as a meta layer. It treats the physical market infrastructure, fiber lines and microwave towers, as the execution substrate. TNQG generates a predictive heat map of infrastructural stress, allowing PTCP to plot a route around network congestion before it occurs. This is an emergent geodesic, routing trade execution along the path of least mathematical resistance rather than the shortest physical distance. By proactively manipulating the physical execution substrate, PTCP outmaneuvers competing algorithms to reach the matching engine first. This method guarantees near-zero slippage, ensuring the capture of the topological alpha. Standard quantitative risk management relies on human-coded stop losses to prevent flash crashes. These reactive limits are often insufficient for the speed of high-frequency tensor network executions. PTCP employs a champion-challenger framework governed by a strict topological envelope. Here, an execution route pushes aggressively against the geometric grid. This flat plane is delta max, the absolute limit of local geometric warping. If a strategy threatens to exceed that limit, the system physically bounds the actuation at the kernel level. By bounding actuation within the geometry, mathematical stability is enforced without relying on reactive human triggers. The time series paradigm relies on the assumption that market signals are isolated, localized anomalies. Tensor networks solve the data constraints of that paradigm by compressing infinite dimensions into a continuous probability geometry. PTCP resolves the fundamental execution limit by translating these predictive heat maps into guaranteed zero-slippage infrastructural geodesics in real time. Together, these frameworks eliminate the boundaries between abstract financial data and physical network geography. By merging topology with physical routing, this framework shifts the performance limit defined by the Renaissance paradigm.